Well, half an hour away from the open in Hong Kong, Shenzhen, Shanghai. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Let's get to the top stories today. A cautious start to trading across the Asia-Pacific. Investors are waiting, of course, some key inflation numbers out of the U.S. Chinese assets also in focus with credit data signaling more economic pressures.
President Biden steps up restrictions on Chinese tech just before his term ends with a ban on smart cards and an executive order on AI development.
And also heads on the show a new standoff in South Korea as investigators try again to arrest President Yoon. That's over last month's martial law declaration.
And the US SEC sues Elon Musk for allegedly failing to disclose his Twitter acquisition in a timely manner. All right, taking a look at the market action this Wednesday morning. Look, we're in the green here this morning, with the exception of Taiwan, actually a little bit in the red so far as it gets into early trade. But very much the focus for investors today is going to be those US inflation figures that are due out later. Dave's going to dig into the details, but a headline, we are expecting an advance of around 0.4%. Core reading, really the one to focus on as well, and what that is going to be telling us for the Fed, and is it that still higher for longer narrative that's going to stay intact? So that's the state of play here. Watching things like the 10-year yield, for instance. I mean, our economics team is saying, there's a confluence of factors that are playing into it. We could hit 5% again this week. Taking a look at Golden Dragon Index overnight, actually we saw a pretty good bump, up more than 2%. We had money supply feeding into that. Really, there is sort of a positive correlation. The more money feeding into the economy, the looser policy stance, that is generally a positive for equities here. So you're seeing that advance. But moving into futures and taking a look at the expectation here, because it's not just that economic data point, you've also got others to be concerned about, and chief among those, Dave, you could really say is the credit data as well we had out overnight, because we had the first drop in 13 years for new loans, and it's that consistent story we've had. You've got more money that's available to investors, to households, to corporates, but do they actually want it? And that has been the big challenge.
Yeah, it certainly is. It's really come up as, well, I mean, it's very early in the year, as something almost as a consensus here. That's the best leading indicator for Chinese equities will be to look at this group of data. In fact, so when you look at it on a headline basis, before I talk about CPI, there are actually some green shoots emerging that might indicate early signs that things are moving in favor of the China stock world. I'll table that for now, leave that as a teaser for you guys. To the point that Bell was making too, inflation numbers are coming through later today. Will this give traders reason to start fading this extremely strong dollar rally? And when you look at the net longs on the dollar, highest in years as far as the net speculative long position when you look at CFTC data. That's point number one. Point number two is the narrative certainly is it's going to take a lot for people to question whether or not this trend can continue. In fact, on that very note here, our Bloomberg economics team have basically put out a note to preview the numbers. And they've put that together with the other bits of data that have come out. And effectively, the narrative here is this will lead likely to higher rates, a longer pause for the Fed, because it will come in, they expect, in line with a lot of the strong data that's come out of late. And I should also give a hat tip to the Bloomberg economics team, Anna Wong, who actually got, on the street, was the only one who got the jobs report bang in line on Friday. So clearly, there are reasons I say this, but because of that, listen to what they have to say at this point in time. It takes us to the China story, right? A stronger dollar leads to a weaker currency. On the currency front today, we have a lot of things to tell you about. So interbank repo rates actually spiked yesterday. Liquidity concerns, watch it very closely today, and what that means really short-term for the dollar. Yuan support is very much in focus, and we will unpack this Bloomberg economics report on China, and they actually think eventually the PBOC will need to let the yuan weaken even further and really catch down with peers today. Still in bear market watch as it pertains to the equity markets. Might not come today, and we'll get any sort of reaction to some of the country garden proxies given the numbers which have come out today. But yeah, a lot of top stories to get to today, Bill.
Yeah, and one of those, of course, is what's happening in South Korea, because it's been, lots of different news dropping this morning. Investigators and police, we understand they've launched a second attempt to arrest the impeached President Yoon Suk-yeol. In a pre-dawn raid, they entered his residence using a ladder, reportedly getting past several lines of presidential security as well. So that's the live shot you can see there. But let's get to Denny Thomas now, joining us from Seoul this morning. And Denny, bring us up to speed. What's exactly happening right now?
Hi. So, yes, so I think it's still, we're in a holding pattern where there is some kind of a negotiation underway between Yoon's lawyers and his team and the investigators who wants him arrested. I think the big picture is most likely you will see Yoon appear for questioning, whether he gets to be taken into custody formally or he voluntarily comes up is the kind of the debate they're having. Obviously, Yoon would want to avoid a blot on his legacy as one of the only or the first president to be taken into custody, and that's the kind of the last minute negotiation that we understand is underway right now. CIO, the investigative agency, is pretty clear and determined to take Yoon into custody. Whether they will yield to Yoon's demands or his kind of request at this point remains to be seen. But I think the second attempt, which was much more organized and they were much more precise in their operation, seems to have gone to their plans, and we're still waiting to see how Yoon leaves his residence after being holed up in that hilltop presidential complex for more than a month now.
Denny, the question I've had since the arrest warrant came out is, apart from that, what else is needed? Because there is an arrest warrant out, and Annabelle just mentioned just now they might have used a ladder. Clearly, it's not just a high fence that's preventing the arrest of Yoon here. What else is in play? What are we not seeing?
So this time around, the resistance has been pretty limited, and they have been able to get to a point where they can physically take Yoon out of his complex. Now, it's just a matter of a kind of mechanics in how they want to execute this warrant. They want to really stick firm and get him, into their vehicle, or they would use a presidential convoy or his own vehicle to get him to his investigative agency. So that's kind of the mechanics being displayed. But I think clearly this attempt has gone well for them, for the investigators. So in terms of what is holding them back, it's just the formality or the operations of how you take a sitting president out of the building is the kind of final thing they are deciding and debating right now.
Denny, thank you. Denny Thomas there, our editor, live for us out of Seoul. From one story to the other top story we're tracking here, and the Biden White House has toughened and at least sharpened its curbs here on Chinese and Russian technology in its final days, seeking to bolster U.S. automakers and also AI developers. Let's bring in Min Min Lo. Our China correspondent has the details for us. Yeah, Min Min, tell us about what's the latest here on this.
Yes, this automobile policy has really been in the works for about a year now. Essentially, it bans smart vehicles containing certain types of hardware or software with links to China and Russia, or the sale of these components separately. It also bans manufacturers with links to China and Russia from selling US-made cars to the US. This means that companies like BYD, for example, they won't be able to open up a plant in the US to sell cars to the US market. And the intention here, of course, US officials are saying that these devices in the smart cars, connecting them to the internet, will be able to gather data on US drivers, infringing on privacy, even allow remote control of these vehicles. And officials now say they are announcing their intention to open up another inquiry to potentially expand the existing restrictions to commercial vehicles as well, such as trucks and buses.
And what about the executive order on AI, Min Min? Because this one seems a little bit more about sort of trying to build up the infrastructure in the US.
That's right. So this executive order essentially will pave the way for the leasing of federal land to companies that are willing to build massive AI data centers. And this is to complement the recent fresh restrictions on the curb of the sale of NVIDIA chips, for example, to data centers around the world. So as you said, the intention is to build up, the speeding up of this domestic build-up of next-gen AI infrastructure. In exchange, these companies must buy an appropriate share of US semiconductors. And this really sets the stage for Trump's incoming administration to chart their China policy, because of course the concern is whether Trump will reverse some of these policies, especially with some ongoing probes that are not yet concluded, for example the one into Chinese legacy chips, for example. But given the bipartisan support or agreement of the China threat on national security, the expectation is that Trump will at least continue some of these policies.
Yeah, and Min, just across the Atlantic here, just want to get the latest here. So this 9-month investigation out of the EU came out with the results overnight, and we'll take us through the details, but the headline certainly suggests that China might have favored local players over EU firms. What else do we know here?
Yes, this is an investigation into China's procurement of medical devices. And yes, the conclusion is that China has unfairly favored domestic companies. The EU is saying that the China's Made in China policy has set a target of about 85% of domestic market share for core medical devices, 70% for higher-end medical devices. The EU says that these targets, this set of complex laws, is unfairly distorting the market, that there are also complex mechanisms, frameworks for procurement that makes it unsustainable for profit-oriented companies, for example, requiring price reduction of up to 90% or requiring that offers be made to bidders of the lowest price range. And in cases where China will need to acquire from overseas, the process is also cumbersome, requiring government approvals, for example, and favoring companies that would carry out tech transfers. So the question now is whether the EU will retaliate by, for example, closing off reciprocal access for China to the EU medical devices market. And of course, this move likely to escalate tension further after already we have seen Brussels imposing those tariffs on Chinese-made EVs as well.
That's our China correspondent, Min Lo. And Min, we actually better give some context on your backdrop as well, because you're at the Goldman Sachs Global Macro Conference, APAC, in Hong Kong. And Min's going to be back with us later with a guest alongside her, speaking with the firm's equity research co-head for China, sharing an outlook on the stock market as well as commodities. Counting down as well to the open of trade in Shanghai, Shenzhen, Hong Kong. This is The China Show.
Oh my God, there we go. The reason I say that is we're coming back almost the very second the fix came out, almost like we did it deliberately. We did. Come on. You guys underestimate us. 718.83 against the US dollar is your midpoint of the day. They've been using this, and they've also been using other measures of late to manage the currency and maybe blunt some of the sharp moves we've seen, whether that's the repo rates, whether that's some of the bill sales we've seen here in Hong Kong. So, they've brought out more tools from the toolkit to really manage what's really been just a really painful grind up in an extremely almighty US dollar. Bloomberg Economics thinks eventually the Chinese central bank will need to let the currency weaken even further and losing its grip a little bit right now. To talk us through that is Chang Shu, our chief Asia economist, joining us here on set. So, we know the yuan needs to be weak. Just tell the story for us. Give us a timeline and what they need to do, what they might do.
Yeah, I think the PBOC is really in a difficult position. I can understand why they're supporting the currency. I think various considerations. They may be still conserving policy room, thinking worse things could come. Think of tariffs imminent could be for this year. And then at the same time, they also are concerned if the currency slides too quickly, that could undermine confidence. But they're putting themselves in a very, very difficult position. The depreciation pressures on the currency are very intensive, even more so than back in 2018-19 in the first trade war.
So what else do you think we can expect then from the PBOC on the policy front?
So on the policy front, the PBOC will have to continue to support growth, and they have pronounced they're going to ease more, essentially, by shifting to loose monetary policy. So to some extent, they will have to kind of really loosen the grip on the currency. We do see, in terms of monetary easing, perhaps another 30 basis point cut in the policy rate, another 100 basis point cuts in the RRR for this year.
Yeah, we spoke with the good folks at Goldman Sachs yesterday, because we did have that briefing from the PBOC and SAFE in the afternoon yesterday. And I think one of the points they were making was, fine, these briefings help, but the economy needs to respond. In fact, let's listen into that and we can get your thoughts on this. Play it out, guys, please.
There was a large move back in September, October, November, and that receded over time. People want to see the actions beyond the press conferences. There's been a number of press conferences, they continue. There has been talk and there has been some action. But I think for the global investor to want to rotate back towards China, we need to see consistency and we need to see significance of activity and action. That's probably not going to occur until March, and so people are very focused on that window. At the moment, it's a bit of a wait and see. There's still a degree of caution.
And Changshu, to the point Kevin was making, the credit data yesterday suggested that overall the economy has yet to respond in a large way to the stimulus. Have there things that have worked so far? What have you seen that has worked, and what's still massively lacking?
Yeah, we do see some sort of moderate pickup in the economy. You do see property transactions are picking up. So there are some positive signs there. But overall, the wider economy has not responded that strongly. And going forward, the government does need a wider set of policy stimulus. Yes, we've been talking about PBOC support. It's very important. And so far, monetary policy has been more forthcoming in many other areas. But as far as we can see, it can only support the overall fiscal and structural policies. So we very much agree with the sentiment, because the economy has really not picking up strongly, and people are waiting. There's a risk sentiment will dip yet again.
All right, Changshu there, that's our chief Asia economist at Bloomberg Economics, and we're really timing things to perfection this morning, Dave, because pre-market is just kicking off for the Hong Kong session as well. We're going to be discussing that in more depth just ahead. This is Bloomberg.
Welcome back. You're watching the China Show. So the credit data yesterday, we talked about it a few minutes back, largely wanting, but there was one data point there that might indicate early signs of a green shoot here. So as you can see, you have M1, that's in yellow, money supply, and you have the CSI 300. Back in 2019, 2020, at the height of the pandemic, this massive pickup in N1 then led to a rally in stocks. We saw a massive pickup from that policy pivot when? September, right? We've been talking about September. Check out that massive. We're almost positive, not quite. We're a lot less negative than the estimates, a lot less negative in November. And as you can see, if that turns positive, it could actually provide Bell a boon for equity markets. Perhaps a good leading indicator to watch moving forward.
Yeah, certainly that big positive correlation we see between money supply and equities. But you know, we had it on the Golden Dragon Index overnight. It was a pickup, and we saw that more than 2% gain. Today, though, we're seeing stocks already under pressure, and you kind of think, okay, how much are the credit figures playing into this as well? Because we saw new loans contracting for the first time in 13 years. We've also got these PBOC equity injections coming in, so we've got nearly 960 billion yuan net being injected through reverse repos. But let's get more on this now. Bring in Michael Liang. He's Chief Investment Officer at Foundation Asset Management Hong Kong, joining us. So, Michael, thanks very much for coming into studio. You know, what we've seen so far, and we can just start sort of big picture before drilling into the finer details, but it's been across the board a very bad start to the year for Chinese equities. What are you making of it?
I think it's in the range trading. I think I mentioned to you guys earlier, most of the economy looking for big bazooka number, physical deficit, increasing leverage. The matter of the fact is the Chinese leverage, if you combine central government, local government, corporate, and households, is quite high for an emerging market. It's somewhere between 250 and 300% of GDP. Depending on which broker or which investment bank you want to listen to.
You trust? Okay, I'm kidding. Go ahead, yeah.
And it's only slightly below Japan, way above many developed countries. So really, in my opinion, the room for higher leverage from now, although I think everybody are looking for a bit more stimulus, more leverage, more money, more printing. But in the end, the room for more leverage is quite limited. In contrary, in my opinion, I would think deleveraging, which a household is already in that situation, but for government and corporations, if they move into deleveraging modes, maybe it'll be painful, but might not be the wrong recipe. Because given the overcapacity within the Chinese economy, do you really want to produce more? Given the geopolitics we're facing today, do you really want to produce more at lower prices? But in the end, they will compete on price. Lower margins, lower return on equities, and so on and so forth. So I think we all have aspiration for government to step in and save everybody in the end, but I guess in the end, the tools in the toolbox are actually quite limited.
Yeah, and I think part of the thesis you're making, and which you'll unpack for us in the next segment, is really investors can't buy GDP. You have to look for these companies that manage to generate a lot of cash, a lot of market share in this kind of environment that might continue. Michael Liang will be joining us to talk us through really his take on where you need to look. If we're not going to get that massive catalyst from a macro front, are we looking in the wrong places for a potential catalyst for the market overall? Michael Liang joins us to talk us through. And really, what's the best way to do it and how you lower the vol on your actual funds to take advantage of the opportunities presented in this market. Going into the open today, 0.3% to the downside. On the CSI 300, Hang Seng Index also lower. Softer numbers ahead of US CPI. The opening bell 3 minutes away. You're watching The China Show.
Welcome back. You're watching The China Show. We're counting down to the start of trade here today and setting up really for a day in the red. Actually, we had the Golden Dragon Index posting some solid gains overnight. That was off the back of money supply figures that were, often positively correlated with equities rising. But today also there's other stories at play, and that includes the credit figures we had coming out. Plus, just in the last few minutes, we've seen another cash injection from the PBOC, Dave.
960 billion renminbi net. That's the net injection of cash via reverse repos going into not just the day today, going into the holiday period, Lunar New Year, of course, it's just around the corner. I think context there as well is we did see a spike in the overnight and the 7-day interbank rates on Tuesday, so that might indicate that maybe we're taking that down a notch. Or so, and removing some of the funding pressure in this market. Shanghai Comp down about 0.2%. Your 10-year yield is seeing a little bit of downside, but broadly speaking, the story across markets is one that is either cautious, extremely range-bound, very low volume today ahead of an inflation print in the United States. Flip the board, please. Have a look at Hong Kong, and we are still on bear market watch for most of these benchmarks. Might likely not happen today. Hopefully not for the bulls. Hang Seng Index was down about 0.3% in the opening going, and here we go. as far as that's concerned. The Tencent story has really been one of not a stock price that has recovered completely. The company's been coming in and really buying back a lot of its stock. And other things of note, Country Garden, of course, came out with its earnings, and we'll unpack that a bit later on as it pertains to maybe what it means for the broader sector. And speaking of cash crunches, cash flow rich companies like Meituan, trading lower, down about 1%. So it's really all about finding cash flows in this market. Joining us still on set is Michael Liang, Chief Investment Officer at Foundation Asset Management. The thesis that you put forward earlier is we focus a little bit too much on the macro. You can't invest on a GDP number. So in an economy like this, what are the best opportunities that we seem to be ignoring?
I think you're hitting the nail on the head. It's the company can generate tons of cash flow without sacrificing margins and still gaining some market share. Maybe the pie is shrinking, but the key is to focus companies can gain market share or bigger slice of the pie. It's not an easy task, I have to say, to figure it out because the generic, macro environment is not so favorable. But that's what I see the dislocation. Sometimes investors come across to Chinese investments. They say, well, demographic is going to be bad. I look at this, I Googled this number this morning. By the turn of the century, the UN forecast the Chinese population will be 770 million, but some Shanghai Institute, I forgot the full name, forecasting 525 million. That's more than half. The Chinese population will be more than half in the next 70 years. And the average age today is about 40. By the turn of the century, will be 60. So, it's a person, right? This person is going to shrink half in size and 20 years older. How much consumption are we talking about here? It's a pretty tough environment we're facing. But the dislocation there is Japan have gone through that demographic headwind for many, many years or decades. But doesn't stop Nikkei from hitting all-time high because you cannot or you do not invest in GDPs. You invest in companies. Companies are the components of indices. So if a company is doing well, or some of the companies doing well, you may still have a very good market, stock market I'm talking about. So that's, in the end, to me, is a stock picker's market environment. Right. Some companies are going to do really well, but, not really well, but reasonably well, but some companies are going to do horribly wrong. In a market neutral setting, when you long company A and short company B, you might have been able to generate some alpha there.
The companies that you're focusing in on, it sounds like, okay, you're looking for ones that maybe have export potential. Is that right? I mean, just give us some more details here. You want ones that can increase their market share. It doesn't seem like they can do that necessarily within China over the longer term, given the declining population. So sector and give us just some more specifics.
Yeah, I mean, let's talk about the names, right? As
yeah, that'd be good.
Feel better about it. Better feel for it.
To buy.
Well, even for example, everybody knows, right? Trip.com.
Yes.
Right. I mean, in that universe, the online travel agents, OTA sectors, right? There's really just two of them, right? Trip.com and Toughens, right? They combined, they have about 80% market share. So where are they gaining market share from? Not necessarily from each other, because when you have oligopoly structure, companies do not compete on price anymore, right? You understand? Otherwise, you have antitrust, all these issues coming along. I mean, nobody's going to win the 100% market. It doesn't make sense, right? So where are they gaining market share from? From the physical mom and pop stores. There's still a lot of offline travel agents around. They are expensive to set up. They're inefficient to operate, and their ability to broadcast a story, service customer ability is shrinking fast in this internet age. So for Trip.com, it's an app. It's essentially a software. Have another 10 million more customers to be on the app, cost them absolutely nothing additional cost. Or, say economy not doing so well, have a 10 million less customers, it doesn't hit the bottom line either. They do need to cut costs to accommodate lower revenue. So that kind of business model, in my opinion, in the next 5, maybe even longer years, are going to do really well because it's not very capital intensive. It's a way of consuming, or doing traveling, booking is the way to go. So this kind of companies we see, in my opinion, will generate a lot of cash, gaining market share without sacrificing margins.
And just for disclosure, Trip.com is part of your strategy, for example?
Yeah, we own that.
Okay.
Yeah.
In terms of finding, and again, the filters you use to find names like this, can we call them counter-cyclical stocks? Stocks that don't tend to move in tandem with the economy. Do you find that group of stocks mostly now in consumer-facing names, or are there someone on the industrial side, B2B names?
Oh yeah, industrial, consumer, tech. Trip.com is not necessarily counter-cyclical. I mean, as you know, right? People feel wealthier, they want to travel more. So actually, every business have a cyclicality. That's the way it is. But in a market-neutral setting, as I mentioned earlier, that's a risk you don't want. You like the business, you like the company, but you don't necessarily like so-called consumption downgrade, right? People consuming less and so on. So by shorting something else, you can hedge out the risk you don't want in your portfolio. That's why it makes our portfolio tend to be very stable, right, and generate alpha at the same time.
Can you give us another name? I mean, what else are you thinking about for this year? I'm just thinking about some of the best performers from last year. I mean, we've often spoken about Xiaomi, for instance, but are there any names that are standing out to you that you think are in a really good position for 2025?
Okay, consumer, we probably know a lot. I mean, I can mention Meituan, but was good performer last year, so okay, it's more of a rear mirror, you're looking at it. Let's forget that for a minute. Let's talk about tech, for example, right? I mean, China is not necessarily in the brackets of making GPUs. Let's face that. But Chinese are very good at making things, manufacturing things efficiently, cheaply, and reliably.
Right.
Okay. So there's a company called Innovance. They make inverters. They are competitor to Siemens, GE of the world, or Schneider of France. So those are they usually use in automation in the factory and also use in EVs as a component. The key of that business is technology know-how. Not necessarily GPU, high-tech, but it's in the industrial products. You need to be reliable, you need to be cheaply produced, and you need to have people to service that because, they also use that in the lifts, elevators, right? So something go wrong, you have people to attend to that, right? So this kind of business in China, in my opinion, can potentially do very well because they are taking market share again. Same way of thinking, same framework of thinking. They're taking market share from whom? From the GEs and Siemens of the world. So-called import substitution.
I think the other point you just made, I think, is important for people trying to pick what overall investment strategies will work in a market environment like this. And you've kept mentioning market-neutral strategies. And here's your plug, right? So the annualized vol on your specific fund is below 10%. MSCI China is at 24%. So already you win just by that alone. So my question is, do you think market neutral is the way to go until otherwise, in terms of just overall strategies?
In our world, many, even in the US focused funds, they first priority is not the return, it's the risk, which is the volatility.
Right.
So it's a forever green strategy. But to implement that in the China context, I see challenges because you're facing liquidity issues, you're facing borrowing, because not every stock is available to borrow. Not every stock is liquid. So, and then, as you know, the Chinese market can be volatile, especially in the situation where you have a policy impulses coming in. The short covering could be very violent. So to manage that volatility in that environment, in this context, actually is very, very challenging. Yeah, but I think the longer-term picture is there's so much divergence among the companies. All right, company A versus company B. Some company going to do well, some kind of phase out. The potential return, it's very enticing.
Right.
The risk is another eye you're going to watch out for, but you need separate tools to take care of that. Yeah.
All right, Michael, thanks very much for joining us this morning. That was Michael Liang there, Chief Investment Officer at Foundation Asset Management. And just to take you back to some of the updates happening in Korea this morning, because earlier we were reporting that South Korea's impeached president would be deciding to appear before the Corruption Investigation Office for high-ranking officials. But this just crossing now, local media is saying that South Korean President Yoon has been arrested over declaring martial law. Of course, we've really seen political turmoil taking place in Korea for several weeks following that. But we'll have more details ahead. This is Bloomberg. Taking a look at some live shots here in Seoul this morning, just some headlines crossing the terminal. We've got it from the Corruption Investigation Office that the arrest warrant for South Korean President Yoon was executed at 10:33 a.m. So that's just about 10 minutes ago from now. That has been confirmed. This has been really an ongoing process, given we've seen President Yoon resisting these arrests, but that has appeared in the end. And so we do understand that he will be appearing before the Corruption Investigation Office for high-ranking officials. So Korean won there, you're actually seeing a bit of a market reaction as well, a bit of strength coming back into the currency. Of course, we did see the dollar move overnight, so possibly a reaction to that as well. But certainly we have seen the Korean won sliding, given these political movements in the country. But we'll leave that there and we'll get more details as we get them to hand. Turning now to what CBS is reporting, because they're saying Israel and Hamas have agreed in a principle to a draft ceasefire deal that would include a 42-day truce and the release of some hostages and prisoners. Let's get the details now with Bloomberg senior editor Bill Ferries in Singapore. And Bill, we've seen these hostage negotiations and these deal negotiations going on in the past. They've fallen short at the last minute. We've also seen a ceasefire that was, basically not agreed to or adhered to within just a couple of days. So given the amount of political pressure that's coming down on this from the US side, do we expect to see something signed and also something adhered to?
Well, you're absolutely right, Annabelle. It does feel like there's a bit of deja vu here, but the one difference I think this time is that pretty much all parties involved in the negotiations are saying that this is the closest they've ever been to actually securing an agreement. There's a lot of details in it. In terms of a phase one agreement, it would, as you said, include a 42-day ceasefire, the release, we believe, of 33 hostages. That's about a third of the 98 hostages who are believed to still be held in Gaza. They are not all alive, but that includes everybody that was taken in the early days of this conflict. And it would also involve the creation of a buffer zone within Gaza and Israeli territory, so that would help prevent any future attacks. The phase two side of this deal is still yet to be worked out. Israel continues to say its goal is the complete elimination of Hamas's political and military capabilities. Hamas, of course, is pushing to have this ceasefire be more of a permanent ceasefire, an end to the conflict. That is still to be worked on, but it does seem that there is some reason for optimism now in this 15-month conflict.
Bill, thank you so much. Bill Ferries, sir, our senior editor in Singapore. Was going to lots to unpack there, but there is some breaking news to tell you about right now. Country Garden has made a statement to us here at Bloomberg on the timing. Here we go. The timing of when the company thinks they can reach an agreement on the debt plan. They do expect that agreement to come in the first half of this year. Now, a little bit of context. Overnight, a few hours back, they did release, of course, the numbers. They do expect things like the loss for the fiscal year 2024 to narrow substantially. They do expect trading in the actual stock will remain suspended. 2023 revenue $400 billion, renminbi. Net loss 178 billion. They do expect that loss and that number to narrow substantially for fiscal 2024. And as far as the agreement goes, and here's the breaking news again, just to recap and circle back there, the first half of this year might be within that window that we might see an agreement there as it pertains to that restructuring plan. More on this later on as we do get more details. Mel.
Yeah, and something else that's grabbing a lot of attention this morning, the SEC is suing Elon Musk for allegedly waiting to disclose his acquisition of Twitter shares in order to build his position at low prices. Bloomberg News editor John Harney is with us. And John, we know the response already from Musk's lawyer on this. They're saying that this lawsuit is a sham, that Musk did nothing wrong, that this is an excessive penalty. But what's the SEC's case in this?
Well, what they say is, as you pointed out, that he cheated Twitter investors out of $150 million by not disclosing in a timely fashion his rapid his acquisition of the stock, which would have raised the price of the stock, and. But his lawyers point out that this is a bogus charge, and that they waited to really the last week of the Biden administration to bring these accusations. And it's striking too, to me anyway, that this company, which Elon Musk has since renamed X, was what gave him a larger-in-life role in the 2024 election, and particularly the Trump presidential campaign.
John, David here. So what's next then? Let's talk about what's the downside here for Elon Musk?
Well, the downside, I mean, I suppose the downside is that it doesn't make him look particularly good. I mean, to have these accusations raised, but in a week, and by next week, Donald Trump, his close ally, will be president, and will soon after have one of his own people running the SEC, and also, I mean, it's also striking that here in a week that Donald Trump's nominees, selections for top cabinet posts, people who will be, running the administration. We're talking about Elon Musk, who supposedly will have a much more informal role.
That was Bloomberg News editor John Harney. Thanks so much for joining us this evening. And going back to Seoul, because we've got an update here. President Yoon, impeached President Yoon, is saying he's agreed to appear at the Corruption Investigation Office, for high-ranking officials, and that is to avoid bloodshed. I'm sure that's a quote from him. So that is the latest we have there. As we've been marking here, the Korean won fairly steady, but we have seen it just a little bit strong against the greenback, with perhaps a bit of a removal of some political tension in the country and a bit more clarity as to what's ahead as well. But plenty more ahead. This is Bloomberg. Taking a look at some of the corporate headlines we're tracking this morning, in Taiwan's central news agency says NVIDIA plans to set up its Asian headquarters in Taipei. The report cites the island's National Development Council minister, saying the company is expected to hire 2,500 people to staff the operation. It also says NVIDIA will establish its Asian Research and Development Center in Taiwan's Kaohsiung. Meta Platforms will cut roughly 5% of its staff through performance-based terminations. In an internal note seen by Bloomberg, CEO Mark Zuckerberg says he has decided to raise the bar on performance management. This could impact roughly 3,600 people worldwide, but Meta also plans to hire new people to replace them. Affected workers in the US are expected to be notified next month. Boeing delivered the lowest number of jets last year since the pandemic. The US plane maker handed over 348 jets, less than half the tally of its European rival Airbus, and about 1/3 fewer than the prior year. Boeing's been working to restore confidence after a turbulent year that included a 2-month strike and production curbs following a mid-air door blowout.
Now, if we look at markets, let's start things off with some recommendations here out of ICBC. So they've upgraded their calls across Chinese healthcare. Some of the names on your screens and the respective price targets. Alibaba Health rated new buy, and I can tell you right now at 430 that is represents some substantial upside. We're currently trading about a full Hong Kong dollar below that specific level. So give or take, that's about a 33%, if not slightly less upside suggested or implied based on that price target out of ICBC on Alibaba Health specifically. One of the stocks that we're tracking at this point in time is Wuxi XDC, and as you can see, we're looking at marginal downside at this point in time. Of course, this is also largely speaking in healthcare. It gave some guidance as far as earnings go. Bottom of your screens. Plenty more ahead here on shows. This is Bloomberg.
Welcome back to the China Show. Taking a look at a live shot of Hong Kong there. We're also keeping an eye on the Hang Seng, and it's actually very range-bound today, Dave. And of course, you've got sort of two different factors. We had the gains yesterday because we had the money supply figures, and that was optimistic because you've often got that positive correlation, more money supply. It's a good thing for stocks. Then we had the credit data that showed that even though there's a lot of liquidity in the system, people don't really want it that much. And so, yeah, we've got, I mean, the CSI 300 is under pressure. Hang Seng, at least, is fairly steady.
That's a good point, because it will take time for the headline numbers and the aggregate numbers on credit to really respond. And I think the point that our MLive team was making, and we'll talk to Mark Cranfield about this, it's really in the sort of small changes month to month that might give traders the clue really how to trade the market, and the massive bounce we saw from September. So what might that bounce then indicate? We could see the CSI 300 rebound ahead. The other big story, well, just to mention too, there are lots of breaking news in the last few minutes or so. Can I just table Korea for now? Because I want to mention, we didn't get to it when we were talking about China, a ton of lines coming through out of Country Garden.
Yes.
Them talking about how the stock will remain suspended, that they do see this debt restructuring, possibly an agreement within the first half of this year. The other thing we're getting here is they have now received, they've said, they've gotten 1.5 billion renminbi in new loans from a government program. And they've also put out some lines here as far as how much more deliveries, as far as home deliveries that they need to get across inventory. This conversation on inventory, I'm just looking for that line right now if I can find it. Country Garden still needs to deliver about 200,000 homes. So that's the teaser of really a story we'll unpack in the next few minutes or so. But yeah, lots of breaking news. There's this, and there's obviously also the CPI print, which is, I guess, a story we could talk about later. And hence, markets are range-bound, no volumes today. But the other thing that you want to talk about is Korea here, Bill.
Well, yeah, because I think it's been, again, really a lot of developments this morning, and we've been sort of tracking a lot of local media reporting as well. But what we understand is the latest is that investigators have arrested President Yoon Suk-yeol. That's after launching a pre-dawn raid on his residence. The market reaction off that, we're actually seeing the Kospi in positive territory today. We've seen a little bit of strength coming back into the Korean won as well. So maybe there's just that sense of relief after several weeks of uncertainty in the country as well. But we know that Yoon is saying he's agreed to be questioned over that short-lived martial declaration. He's saying it's to avoid bloodshed. Maybe there's just also that inevitability factor as well. But let's get more with Hee-Soo Lee joining us now live from Seoul. And Hee-Soo, you're also, it's a very busy morning for you as well. So just tell us what's the latest and what are you learning there on the ground?
Right. So early in the morning today, we've been seeing heavy police deployment near Yoon's residence from about 3 a.m. And the CIO, which is the Corruption Investigation Office for high-ranking officials, which is leading the investigation, arrived at President Yoon's residence before 5 a.m. today to execute Yoon's arrest warrant. This was the second attempt to bring Yoon in for questioning after his declaration of martial law in early December. A few hours into the operations, some of the investigators managed to get to the third set of defense lines set by his security team. And while this was going on, Yoon's main lawyer signaled that some negotiations were underway between Yoon and the CIO. And now we were able to see Yoon arriving at the CIO office about 10 minutes ago. We are getting headlines saying CIO will begin investigation over Yoon soon, and the CIO has also said that Yoon's been arrested. But at the same time, the lawyer from Yoon's side is saying that the attempt, they're not accepting the CIO's attempt to arrest him and the investigation at the moment. So there's a lot of confusion.
Yeah, so of course, as we were saying, this has been going on for several weeks now. What is going to be the reaction then, do you think? I mean, the markets, we're seeing relief, but do you think for people as well, Koreans, are they going to also be sort of pleased to see this result for the most part?
Yeah, well, it's been going on for so long, and we've been seeing, over the weekend and even like during the weekdays, there were a lot of rallies around Seoul, basically, and where his residence is pretty much the heart of Seoul. So there has been a lot of traffic jams and a lot of confusion in the country. A lot of, it's the beginning of the new year, so a lot of policies and things were not moving as they should. And so, yeah, a lot of Koreans are quite pleased to see that there is some development in this. But, as I said before, there are a lot of confusion, and so it's difficult to predict what will happen next. And there will be continued disagreement between Yoon and the CIO, which is the investigators. So we would have to see what will happen today.
Hee-Soo, thank you so much for getting us up to speed. Hee-Soo Lee there, our reporter over in Seoul. Bloodshed avoided. Hopefully, that's according to the Yoon just now. Back to the Chinese markets, and some green shoots might be emerging here. We'll show you a chart, and Mark Cranfield is joining us, in fact, right now to help explain the chart. And Mark, you flagged this to us before the show started as a chart that we need to be watching over the next few months. What is this chart telling you?
Well, finally, money supply, as measured by the M1 index in China, is finally starting to pick up. It's actually, on a year-on-year basis, it's actually still slightly below zero, but you can see that yellow line on the chart there is starting to turn positive, which is very, very good news, because if you look over a long-term period, there's a clear correlation between rising money supply and how it helps to improve the outlook for Chinese equities as well. Now, you've got the PBOC, the central bank in China, have also been making it pretty clear since they started talking about stimulus last year that they're working very hard to make sure there's plenty of liquidity in money markets. They're intending to lower interest rates again. And it's official policy from the Chinese leaders that there will be an accommodative monetary stance as well for the first time in several years. So all of those things are working together. Now, it takes a while to get money supply really ramping up to the kind of levels which we've seen in the past, but at least it's beginning to do so. So people will be watching that this year to see how it develops. Certainly, once there's some traction in expanding the money supply, it will show that money is feeding through to the key parts of the Chinese economy that really need it the most. So it's set to be a very good indicator for what's happening in China. Providing it continues to edge higher, it's going to be good news for equities.
Mark, we were speaking with David Kostin, who, of course, looks at U.S. equity markets for Goldman Sachs. And, we've been talking about how the story in China has been one of late that, the foreign investors have largely stayed away. And where the market goes will depend on that incremental buyer coming back. So our colleague Min Min, who was at the Goldman conference, asked David Kostin, what would it take? Does he see any interest from the people he's speaking to in the U.S. to reallocate back to China, and what it would really take for them to do that? Let's listen in.
We have not seen a lot of interest in terms of my conversations. To be fair, my focus is primarily on the U.S. equity market, but when talking to U.S. companies, U.S. investors, the question is more about can they get perhaps China access via U.S. equities if they had to do so, as opposed to owning the actual U.S. Chinese companies. That's the questions that I'm receiving.
Yeah, Mark, that second point that David just made there, I'm interested to get your take on that. That, U.S. investors first have their options, their home bias in their market, options to get exposure to. They don't have to go to China to get exposure to China is the point. And I guess the point I want to get to is, does the FOMO sort of conversation apply differently to foreign investors looking at this Chinese market, which may rally, and they're fine to, miss that initial part of the rally?
I think you probably want to think of it in terms of foreign investors are the icing on the cake as far as China is concerned. Don't forget, there's an enormous domestic market, an enormous fund management market in China, which is largely captive to onshore equities in China and to some extent equities in Hong Kong as well. So there's an enormous amount of money which is available to invest in Chinese equities anyway. If they believe in the positive story that the government is helping to boost the economy, that they're doing the right things for the consumer, Chinese equities can rise anyway because of the onshore money shifting into Chinese equity portfolios. So that is something which can take place regardless of what foreigners are doing anyway. Of course, at the same time, it's even better if foreigners look at whether it's European companies, American companies, other parts of Asia, people who may benefit from the China story, whether it's electric vehicles related, AI, whether it's any consumer sectors, anything where foreign companies can start to benefit from the trends that are taking place in China. But that's really the icing on the cake. It is not the main part of the story. The main part of the story for Chinese equities is that the Chinese government is pushing into the right areas of the country, it's boosting the economy where it matters, and it's getting its own people to invest money away from bonds. That is probably the most important thing, is they take more money out of bond portfolios and shift it into equity portfolios. If that happens, Chinese equities will do fine, regardless of what foreigners do.
Mark, Dave just mentioned before about the thin liquidity we're seeing today because of the US inflation print that's coming out later. But last year we sort of started to see CPI prints having less of an impact as investors became more confident in the Fed's cutting path. What kind of reaction do you think we get today, given how much investors are really concerned that, maybe the next move is even a hike? And the numbers today really could cement as well at least a higher for longer narrative.
I don't mean to belittle economic data, but this might be the most inconsequential US CPI report for years because it's happening before Donald Trump becomes president. Everything from next week could change the inflation outlook dramatically. People are already thinking that we haven't actually seen precisely the policies yet, but we do, and it's widely thought that policies from Donald Trump will boost the US economy, lower taxes, and generally start to push inflation higher. So whatever number you see today is probably going to be, the market is probably just going to shrug and say thanks very much, but we're much more concerned how Mr. Trump's new policies will push the inflation outlook from here onwards.
Mark Cranfield there, our MLive strategist in Singapore for us, out with a 5-syllable bomb, really, inconsequential. So maybe just a word of advice. We probably have, what's the next show? We have Insights, of course, with Haslinda, and the producers are in. The Middle East show is coming in. Advice from Mark Cranfield: if you have U.S. inflation in your A block, toss it out the window right now. Not an important story. The boat has left the harbor for us. We already did it. Anyway, coming up ahead here on the channel. I'm just keeping it real. Our friends at Goldman Sachs will be joining us, and we'll be live there at the Goldman Sachs Backer Conference taking place here in Hong Kong. The co-head of Greater China Equity Research, Trina Chen. By the way, she made a very big call last year, this overcapacity issue. She's actually outlined some sectors which might continue to see that, and some sectors where the light is visible at the end of the tunnel. Plenty more ahead. This is the China Show.
Country Garden says it expects to receive, or reach rather, an agreement with offshore creditors on its debt restructuring plan in the first half of this year. The Chinese developer made the statement to Bloomberg after belatedly reporting another record loss for 2023. Our China credit reporter Loretta Chen joins us now. And Loretta, I mean, the debt crisis in the property sector doesn't show very much progress or signs of improvement. What do we make of this latest acknowledgement from the company?
Yeah, Country Garden has been really negotiating with creditors for over a year to reach a debt restructuring plan. And there's been several delays, in terms of that agreement. And now the company kind of sort of give out a deadline, which is by the first half of this year to come up with an agreement. But, going back to some of its peers, for instance, Sunac, which is another Chinese developer that is among the first to actually reach a restructuring plan with creditors. Now the company has actually come out to, suggest that there is a potential second restructuring on some of its offshore bonds. So, that's really a sign that the fundamentals haven't really improved in the China property sector, and that's also affecting how effective these restructuring plans can be really executed, going forward, because you might see these repetitive defaults happening to these developers again and again because, they really can't improve their cash flows because homes are not being sold.
Speaking of that last point, Loretta, they also mentioned, some of the inventory that they still need to unload. What more do we know about that? And also, they managed to secure this loan from a government program. What do we know about that?
Yeah, I think for developers like Country Garden, their priority, which is defined by the government, is really to ensure the house delivery, and they're relying on a lot of government funding to do that. And these government funding really don't go into helping these developers to pay back debt that's to its bonds, which is considered secondary. So I think Country Garden it's still in the process of really prioritizing a lot of that home delivery, and I think that's part of the reason why we're seeing continuing losses on the company's financials, because a lot of that financial resources is really used to being made to ensure that the home buyers are getting their houses. So I think that's just a continuing pattern that we're seeing within the property sector, where developers are really doing a lot of state service, so to speak, for the home buyers.
Loretta, it's a really busy week ahead for distressed Chinese property firms because they've got a number of court cases coming up. One we do need to mention is the offshore subsidiary of Evergrande, Tianzhi, that's just had their winding up hearing adjourned to March 12. But even with that out of the picture, were at least 7 firms that we're going to be looking at this week and defending themselves. So what are we expecting here exactly?
Yeah, so this is especially a busy week for a lot of these developers. Some of them, are, frequent sort of visitors to the Hong Kong court. So you have Shimao, which actually faces a second winding up petition after the first one against the company was kind of cleared. And there's also another winding up petition for Country Garden. And then you have also some other companies that actually come from the previous credit cycle in the China credit market, such as Suning or HNA units. So they're also trying to, kind of, I guess, clear up the restructuring process that they had with creditors. These are companies that defaulted really 3-4 years ago, and you're still seeing them, continue to appear in the Hong Kong court, trying to clear things up with creditors. I guess that's kind of also an ominous sign for a lot of the creditors, trying to negotiate on the current restructuring terms with developers. They might also face that repetitive process in terms of keep going back to the Hong Kong court, filing these winding up, because that's one of their main tools used for a negotiation.
Loretta, thank you so much. Loretta Chen, our China credit reporter, on the latest here on Country Garden. Okay, we'll have a look at some stock movers on the other side of this break. Stay with us. Right, welcome back. Welcome back to shows here. Just to recap some of the headlines coming through and key developments in this fast developing story over in South Korea. So, well, very quickly, about what time is it now? About almost 50 minutes back, the arrest warrant was executed for President Yoon. He's now been, of course, he was then transported to the Korea CIO to begin an investigation where it will be over very soon, maybe just to bookend that as well. He has mentioned and put out a statement while he was at the CIO talking about how he decided to do this to avoid bloodshed. He's agreed to appear at the CIO to prevent bloodshed, and that his appearance doesn't mean that their camp has accepted the investigation. That's what we know so far here.
Yeah, very, very fast-moving story and a lot of developments to keep on top of. But we'll have more updates ahead on that. In the meantime, Goldman Sachs chief U.S. equity strategist says he expects the surge in U.S. nominal and real bond yields to ease this year, with inflation being slowly tamed. David Kostin spoke to us exclusively from the company's Global Macro APAC conference in Hong Kong and also gave us a bullish outlook on U.S. stocks.
I think the way to think about it, and the conversations we've been having with portfolio managers here at the conference, is the idea of the S&P 500 index rising to around 6,500, which would be around 11% gain from the current level. The way to think about that is earnings per share likely to grow around 11% in calendar 2025 and about 7% in calendar 2026. So equity investors are already thinking about not just the current year, but looking into the next year. Specific to this conference, we've been focusing a lot of questions around the fourth quarter earnings season that is about to kick off today. And so from earnings growth for this quarter reporting is around 8% gain. And one of the big questions has been, what's the impact of a strong dollar? The strong dollar that really was notable in the fourth quarter would suggest that the magnitude of surprises in the reporting season are likely to be somewhat less than you've seen in the last, say, couple of years. Typically, you get a earnings season where the positive surprises are around 400 basis points. So if that was the case, you'd have earnings growth something closer to 12%. I think that's not likely to be the situation this quarter, probably a little bit less. Some positive surprises, but not so much. So we think about the general trajectory of the U.S. equity market. Earnings are the driver, not multiple expansion. The U.S. stock market trades around 22 to 23 times forward earnings. That's a very high multiple, historically speaking. So it's really earnings that are going to get us to our target of 6,500.
Okay, so you talk about dollar strength, but we also have very elevated yields right now. Obviously, we're waiting for inflation data. Do you think we're at the peak of yields, and to what extent is that going to be a headwind for equities?
Well, a higher bond yield environment is a concern. It's a concern for a couple of reasons. One, the speed with which bond yields have backed up. Both real and nominal yields have gone up almost 50 basis points in 1 month period, which is a very swift and high magnitude of movement in a short period of time. And historically speaking, that's been a headwind for equities. And in fact, equities in the last month have sold off slightly here in the United States. So the idea of a higher bond yield environment would be a headwind for really strong returns. Our expectation is that inflation is coming down slowly, and that bond yields will fall over the rest of this year, something closer to 4.25% on nominal yields, down from the current level, which is much higher than that. So I'd say that's a big area of focus for fund managers. One of the questions we spent a lot of time with yesterday on the first day of the conference.
And that was David Kostin out of Goldman Sachs speaking exclusively with our China correspondent Min Milo earlier on at their macro conference here in the city. Right, just going into the 60-minute mark of the cash markets, and we're trading extremely range-bound across Hong Kong and also mainland China, going the opposite, almost a mirror image of the opposite way. Plenty more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets just about to go into their lunch break, and we're seeing some modest gains here. Markets are fairly range-bound and there's not too much liquidity, but one of the stories we're tracking just dropped from Reuters in the last couple of moments, and they're saying that Japan is likely to miss achieving its goal of running a primary budget surplus by the next fiscal year. That's according to some sources, and that's because we know the minority government is facing increasing pressure for more spending. They were targeting for a budget surplus by the fiscal year starting in April, and actually if they had done that, it would have been the first surplus since the goal was introduced in the early 2000s. So it just really speaks to how much debt the Japanese government has. But let's take a look at as well what's happening with yields today, because we have seen a confluence of factors building here, and some, for instance, our Bloomberg economics team saying that 5% on the 10-year Treasury could be possible again this week. We touched that last week, but today we're just seeing yields moving a little bit higher. At the same time, we are seeing, at least in the Treasury space, some bets that are building here for yields to drop to 4.6%. But Dave, I mean, I'm trying to avoid saying US CPI, given we've just been told it's inconsequential, but that is still one of the narratives today, I think, for the session.
Well, you did it. I'm going to avoid it.
Distance yourself. Okay.
I'm going to avoid it for now. I think the one but it's interesting though, the one you're mentioning here there are bets emerging that the rally in treasuries might be around the corner. I think you have some of the the ratio between call and put options is about to turn positive on some of the longer dated treasuries, which might indicate there is some buying taking place across the bullish option space there. The other story we're tracking here is you have now the U.S. has added 37 China-based companies to this Uyghur forced labor list. Among those in the list are on your screens. Zijin Mining, of course, part of that new list out of the United States. Okay, let's take it straight back to the Goldman Sachs Global Macro Conference here in Hong Kong, where our colleague Min Min is standing by with her next guest.
Yes, joining me now to discuss China commodities outlook is Trina Chen, China commodities analyst with Goldman Sachs. Trina, so great to have you here. I want to start with your outlook, in particular on steel and cement, because you said that it's going to be the most stable year since 2021. I found that a little bit surprising, just given the dire warnings last year from Chinese steel companies that we could be facing a prolonged winter ahead. So what is driving this outlook?
Yeah, I think the big changes here is really on the demand side. We are expecting a return of infrastructure activities. I mean, the past 3 years is really mostly about property and then some softness of infrastructure projects. I think the property correction, because the absolute construction activity has shrunk already quite a bit. So now infrastructure is a bigger part of the construction demand, which actually has been facing tremendous problem because of local government debt. Effectively, the dollar actually went into the infrastructure projects from the funding has getting lower and lower, despite there has been pretty stable on the surface support to the infrastructure. I think it has been the biggest victim of local government debt, financial distress. And I think now the trend is reversing. We are seeing a very large-scale local government debt resolution plan. That's right. As a result, working capital should improve significantly at the local government level, and therefore return of the infrastructure projects. Half suspended or new starts, we expect all of them probably will come back. We have made pretty prudent assumption that it's no longer going to decline this year. It's going to stabilize for a couple of years. I think there's also a chance for a bit of a upside risk based on how we track the activities on the ground. Okay, so is this government-led sort of rebound in infrastructure activity? I'm curious though, because last year we saw downward pressure on things like iron ore, largely because of this contraction in domestic demand and the overcapacity issue as well. Have you seen an improvement in that situation, and in terms of cash margins for some of these companies as well? Well, I think on the iron ore supply demand itself, I think it's unlikely to, if you have a stable demand, unlikely to make too much changes. However, the expectation ahead of the construction season last year was very high. So we went into the construction season post-Chinese New Year. There was no seasonal pickup. and therefore price correction. So we had 2 rounds of that on iron ore for March and September. And this year is almost the opposite. Everybody went into Chinese New Year with very, very timid restocking, given there's very little expectation.
Right.
So, but given the fundamental change on demand, at least I think in the upcoming construction season, we see some surprises. The oversupply problem on steel is still there, so the pressure will still be there on the margin. But on a relative basis, I think we are a little bit more positive, I would say, on flat steel, which actually goes into the manufactured products.
I remember you had a report on the overcapacity issues in various sectors in China, and the top sectors last year had been solar panels, lithium batteries. How close are we to this inflection point around that?
I think we are already clearly seeing the bottom, to a certain extent, a little bit of a pickup. I think in margin, if anything, the idea is we have since middle of the last year, we have seen from producers' perspective already supply responses, curtailment in terms of production cut to bring the balance back to the market. But in the meantime, we're also seeing continued capex, actually deceleration in responding actually to the overcapacity. We also see policy changes actually on a very holistic view across many oversupplied sectors, including some of the commodity sector, like steel or cement.
Okay, so let's talk about lithium prices. What's your projection there, and for the earnings of the big lithium producers as well? Because as far as I understand, since September last year, the domestic lithium market has been running at a deficit.
Yes, clearly you've been reading our report, so thank you for that. That's absolutely correct. I think that the market has been a deficit since September, on the back of 2 reasons. One is we have definitely seen supply responses, curtailment, production cut. So that helped to floor the actually pricing from falling off further. I think the other things we have to say, the stimulus on the trading program for EVs clearly has helped. So we've seen strong battery demand. We've seen strong energy storage demand on battery as well. So both these 2 factors together is holding the market at a balance. I think the only issue now is, it's always my view that you need to have less capacity to bring pricing powers back to really have a sustainable pricing improvement. And production cut, at best, only stabilize price at the floor. And that's kind of where we are there for 2025. Capacity is still available on the side. We need time to digest those capacity. We need to see capacity development slow down. But in the meantime, pricing clearly has found its floor, but the recovery probably will be capped in 2025.
Okay, probably will take time for that. I want to talk about the US-China relations, which has been very much in focus. And given that China has been using its dominance in rare earths, critical metals as a sort of leverage over the US, which area do you think is China most at risk in terms of its capacity to be self-reliant? Because you were saying something very interesting about bauxite there.
Well, I think self-sufficiency in many areas, in my observation, has become more and more a policy strategic focus. So I think at Goldman Research last year, we did so much work on food security, on energy security, technology security. So the idea is the reliance is there, but there's definitely a domestic effort to change that. Now, for example, in US-China, people would naturally think about soybean. This is one area China has to import quite a lot. But soybean import as percentage total consumption has not really moved up in the past few years, which is quite amazing. I think this is attributable to domestic effort in terms of improving yield, actually reduce consumption using some of the substitution. And then similar as that, I think this is an effort in kind of a coping with long-term reliance. But one commodity I wanted really to bring up is actually bauxite. And this probably has less to do with U.S.-China relationship, but more of a China is increasingly import the use of bauxite for very important metal production, aluminum. And now self-sufficiency has came down rapidly in the past 5 years, and now it's only 20%. Yes, 20% self-sufficiency. So we are actually expecting it, at least in the medium term, higher and longer bauxite prices, which is very different than when I first started this industry, when my boss told me, low prices, bauxite supplies everywhere. I think the world has certainly changed around there.
All right, thank you very much. There you go. Some of those metals that could be the target of perhaps potential tit-for-tat retaliation between US and China. And that was Trina Chen, our China commodities analyst from Goldman Sachs.
Thanks very much. That's Bloomberg's China correspondent there, Min Lo, at the Goldman Sachs event in Hong Kong. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and to our guests during our live programming. So check it out at TV Go. This is Bloomberg.
Some global headlines for following and tracking this morning. Israel and Hamas have reportedly agreed in principle to a draft ceasefire. Now, CBS News cites Arab and U.S. and Israeli officials saying the deal could be finalized as soon as this week. But both President Biden and also President-elect Donald Trump earlier said that they were optimistic a truce was close. Israeli officials say the first phase would include a 42-day ceasefire, the release of some Israeli hostages and Palestinian prisoners, and a buffer zone in the Gaza Strip. Southern California residents, exhausted by a week of wildfires, evacuations, and blackouts, are facing yet another night of critical fire danger. Returning Santa Ana winds are threatening to fan the flames, with more than 10 million people, in fact, facing what officials call a particularly dangerous situation. Now, estimates of the insurance bill keep rising, with Keefe, Bruyette, and Woods now seeing losses as high as $40 billion, which is double their figure from just a day earlier.
Yeah, and the EU's climate chief says Europe too must prepare for more intense wildfires. Wopke Hoekstra told us exclusively that the recent string of natural disasters around the globe should create more urgency for climate action.
In my view, what is truly at the heart of the matter of what Europe needs to do, what I need to do, is make sure that we, on the one hand, continue full-fledged with climate action, simply because science is crystal clear that we'll see more rather than fewer disasters. But we marry that, we bridge that much more effectively with the realm of business and competitiveness, and with a fair and just transition for our people. That is in essence what this commission and what I need to do in the next 5 years.
And I'd like to get into those, but I think specifically I'd like to just talk about quickly about the wildfires in California, because there is a sort of preventing the CO2 from getting into the atmosphere side of your job. Then there is the dealing with the crisis once it is unleashed. Well, how do you sort of think about that problem here in Europe and sort of preventing what we have in California, where they were clearly very ill prepared to deal with what is an immense crisis?
What we see, and we've all seen the truly devastating news from the U.S. Absolutely horrible to see what it does to the people over there. But unfortunately, of course, we have seen a range of these type of events also on European soil. Wildfires, floodings, droughts, with huge effect. And the reality is that given that temperatures are on the rise, we will see more rather than fewer of these events going forward, affecting human lives, affecting our economies, affecting even the domain of geopolitics and safety and security. So you're absolutely right. On the one hand, we need to continue with all our efforts towards what we call mitigation, basically driving down emissions. But that alone, unfortunately, no longer is good enough. We also need preparedness. We need adaptation, so that when disaster hits, whether that is a potential flood, whether that is drought, we become far more effective in making sure we manage it as well as we can.
And that was EU Commissioner for Climate, Net Zero and Clean Growth, Wopke Hoekstra, speaking exclusively with Bloomberg. Now, taking a look at some corporate headlines that we're tracking this, well, I'm reading a lot of news today. Taiwan's central news agency says NVIDIA plans to set up its Asian headquarters in Taipei. The report cites the island's National Development Council ministers, saying that the company is expected to hire 2,500 people to staff the operation. It also says NVIDIA will establish its Asian Research and Development Center in Taiwan's Kaohsiung. Meta Platforms will cut roughly 5% of its staff through performance-based terminations. In an internal note seen by Bloomberg, CEO Mark Zuckerberg says he has decided to raise the bar on performance management. Now, this could impact roughly 3,600 people worldwide, but the company says, or also plans, by the way, to hire new people to replace them. Affected workers in the U.S. are expected to be notified next month. Now, Boeing delivered the lowest number of jets last year since the pandemic. The U.S. plane maker handed over 348 jets. That's less than half the tally of its European rival Airbus, and about one-third fewer than in the prior year. Now, Boeing's been working to restore confidence after really the turbulent year that included a two-month strike and production curves following a mid-air door blowout.
All right, let's get right into today's big take. The story today is focusing on Toyota and the company's prioritization of hybrids, gas guzzlers. It's definitely made it the Japanese company, the world's #1 automaker, but that success also raises the risk of Toyota being left behind. Let's get more with our senior editor, Reed Stevenson, joining us this morning. And Reed, really great big take. The challenges that have also underpinned the success of Toyota seem to come back to a management philosophy called Kaizen, which is something that I actually hadn't heard about before. So just share the details with us.
Well, Kaizen is part of a larger sort of philosophy that's known as the Toyota Production System. And it's really not just about manufacturing, but really a way of running the business. And the best example of that, and what has led to Toyota's success in building more than 11 million vehicles a year, is this idea that, you serve all markets. They sell cars from Africa to the Middle East, North America, and of course in the home country of Japan. And that means having products that fit every market. And to a large extent, this has paid off. The transition to EVs hasn't happened as quickly as many thought, and so there's still a lot of residual demand for hybrids, and that's where Toyota has excelled. But what we did was we sort of went and looked at the nitty-gritty, the components that go into EVs, and found that there's still a lot to learn. I mean, it's essentially much harder to transition from being a legacy OEM automaker to starting from scratch, and so we found this in some of the sort of components that we looked at. For example, one part that was made out of plastic when it comes to Tesla and BYD vehicles, but still made out of steel for Toyota vehicles, Toyota's EV to be more specific. But again, the idea is that this philosophy should also encompass the idea of learning, the learning from others, learning and improving on things. And that's sort of the thesis, whether Toyota can really kind of embrace this change and really keep its position as the world's largest automaker.
Reed, David here, there's also a part of the big take today talking about how, longer term, this almost fundamental rethink of the philosophy, this family business. And how does that then, I guess, in some ways present just a massive challenge for Toyota to get to where it wants to be in this specific space?
Yeah, I mean, it's akin to sort of, moving an aircraft carrier, right? It's there are customers, and there is sort of a very large legacy business that they want to keep servicing. And so, we've had these sort of existential debates about, Tesla coming up and BYD coming up because they've started from scratch. Toyota is really, the best way to maybe look at it is it's really a test case of how adaptable a large legacy automaker is going to be in the era of EVs.
Do you think that Toyota needs to shift away from Kaizen, or do you think that it actually can prepare it for these challenges? Because it's very difficult to sort of continually iterate when you're really just trying to make a fundamental change.
Yeah, I mean, there's probably zero chance that Toyota is going to abandon, a tried and tested manufacturing and management philosophy. I think what you're going to see is sort of a situation where initially there's going to be, bumps. It's going to sort of be an opposing force in the beginning, but I do think that once you clear that hump, or if you can clear that hump, then it kind of kicks in again, and they have plenty of opportunity, scope, and even the financial foundation to then iterate and improve on that. And so really, we're just going to have to see how all of this plays out.
Reed, thank you. Reed Stevenson, our senior editor, and you can read the full story in a terminal for subscribers. You can check it out, of course, and a Big Take and on the website on Bloomberg.com. Okay, there's no really real transition here, apart from the fact that both these stories have a T in them. Toyota transition to Taylor Swift. Maybe that's good enough. We are looking at reports right now that the good news for Swifties in talks for a concert in Shanghai. I wonder if you could chime in on this, because I'm running out of things to say.
Well, I was wondering actually earlier,
in.
is David a Swiftie? But I'm getting the sense that you're not.
No, not at all.
I'm not either, but I think that there are still some interesting metrics we can talk about in this.
I'm not big on heartbreak. That is really
not
the
big
philosophical.
On heartbreak. Okay, all right, taking it one step further. But anyway, what we're understanding is the Shanghai Tourism Office is optimistic that Taylor Swift might come this year, because we had the Eras tour that wrapped and there wasn't a single performance in China. Of course, we had, for Asia, it was really just in Singapore. That was where we had it. I don't think Tokyo either.
And I think that's interesting. I wonder, though, if this does happen, that the Singapore series of concerts caused a bit of friction with some of its neighbors, because they effectively monopolized that part of the world. Which then, to the point of some of the neighboring countries in Southeast Asia, said, okay, why do we get a Taylor Swift concert? And I wonder whether it might be just in Shanghai.
Maybe, but what we do know is that the last time Taylor Swift went to China, the Shanghai stop of her 2014 tour sold out within a minute. So as well as she does come, good luck getting your hands on some tickets. But more ahead, this is Bloomberg.